Now we'll talk about long-term solvency. Long-term solvency means whether the firm is capable of paying long-term loans or not. I give you one example. Suppose you have invested in the business rupees 10 lakhs and you go to the bank for a loan of rupees 1 lakh. It's a long-term loan. So what are the factors the bank would like to consider about your financial position? Naturally, number one, how much you have invested in your business. You have invested 10 lakhs. So it means the bank will be quite comfortable in giving rupees 1 lakh to you. Because the bank knows if anything goes wrong, the bank can recover its money by selling your assets. Suppose we take another example. You have invested only rupees 1 lakh in the business and you go to the bank for a loan of rupees 10 lakhs. In this situation, bank won't be comfortable in giving loan to you. The reason being, if anything goes wrong, how will bank recover its money? Even if bank sells your assets, bank will recover only rupees 1 lakh. So bank will be at risk, means margin of safety is very, very low. So in this way, whether the firm is capable of paying its long-term loans or not, it always depends upon the two things. Number one, debt. Number two, equity. That's why this ratio is called debt-equity ratio. Debt-equity ratio means this establishes relationship between debts and equity. Debts means long-term loans and equity means shareholder funds. In the case of company, it is called shareholder funds. Otherwise, it can also be called own funds or owner's funds. That's the same thing. So long-term loans means the firm has to pay in long term, not in short term. Now the question is how to calculate equity, means owner's funds or shareholder funds or own funds. The formula of calculating shareholder funds is capital plus accumulated profits minus accumulated losses. This is the real capital in the firm. And accumulated profit means you may find on liability side general reserve, reserve fund or profit and loss account. Basically that is the credit balance of the profits. And on asset sides you may find some accumulated losses. You may find profit and loss account. In case of company, you may find preliminary expenses, discount on issue of debentures, share discount, loss on issue of debentures, etc. In case of company, all these items, I mean to say accumulated losses, are under the head of miscellaneous expenditure. So I was just telling you how to calculate shareholders' funds, that is capital plus accumulated profits minus accumulated losses. There is one more way to calculate shareholder funds, that is net fixed assets plus working capital. Net fixed assets means fixed assets minus provision for depreciation, and working capital means current assets minus current liabilities. So long-term lenders are always interested in the debt-equity ratio, because only through debt-equity ratio they can find out whether they are safe or not. Means only debt-equity ratio can tell them the position of the safety of margin. Now let's take one example. Suppose this is the balance sheet of a firm. I am making this balance sheet in a very rough format. Capital rupees 10,000, general reserve 5,000 rupees, creditors 1,000 rupees, long-term loans 9,000 rupees. Building 15,000 rupees, profit and loss count 1,000, debtors 9,000, and the total of the balance sheet is rupees 25,000. And you are asked to calculate debt equity ratio. Debt equity ratio means debts upon equity. Debts means long-term loans and equity means shareholders' funds or owners' funds. First of all, we have to find out long-term loans. Long-term loans, naturally, they are always found on the liability side. And on the liability side, the long-term loans are rupees 9,000. Now we have to calculate shareholders' funds. Shareholders' fund means capital, that is 10,000, plus accumulated profits. Profits are, accumulated profits are always on the liability side, that is general reserve rupees 5,000, minus accumulated losses. If there are accumulated losses, you will find it on asset side. And on asset side, there is profit and loss count rupees 1,000. So it will be deducted. So net shareholder funds are 14,000 rupees. There is one more way you can calculate shareholder funds, and that formula is net fixed assets plus working capital minus long-term loans. So let's look for the fixed assets. There is only one fixed assets in the balance sheet, that is building, means 15,000 rupees, plus working capital. Working capital means current assets minus current liabilities. And current assets are 9,000 because we have got only one current assets, minus current liabilities. There is only one current liability, that is creditors, 1,000 rupees. It means working capital is 8,000 rupees. So in this way, shareholder funds will be 15,000 plus 8,000 minus long-term loans, that is 9,000 rupees, means 23,000 minus 9,000 is equal to 14,000. So we have got two options to calculate shareholder funds, either capital plus accumulated profits minus accumulated losses, or net fixed assets plus working capital minus long-term loans. So as per the question, the debt equity ratio will be debts upon equity, and debts are 9,000 and equity is 14,000, means 9,000 is to 14,000, means 9 is to 14, or we can say 6.4 is to 1. Capital employed. You know about capital, but maybe it's a new thing for you. Capital employed. Capital employed means the funds available or at the disposal of the firm for a long term. So when we start the business, there are two things. Number one, we invest our own money, which is called capital. It is not to be repaid in short period or long period because it's our own money. and plus we borrow money from outside for a long term, which are called long-term loans or debts. The total of the capital plus long-term loans is called capital employed. But be careful. Capital means shareholders' funds. It means the exact definition of capital employed will be shareholder funds plus long-term loans. And long-term loans are also called borrowed funds. Let's do one question. In a firm, suppose capital employed is 24 lakhs and long-term loans are 16 lakhs. Calculate debts equity ratio. You know, debts equity ratio means debts upon equity. Debts means long-term loans upon shareholder funds. And long-term loans are 16 lakhs. But now we have to calculate capital employed. You know, capital employed minus long-term loans is equal to shareholders' funds. It means the debt equity ratio in this question will be 16 lakh is to 8 lakhs, means 2:1. And the best expression of debt equity ratio is, for example, in this question, 2:1, 1.9:1, 3:1, means shareholders' funds should be expressed as 1. And low debt equity ratio is always better in any firm. It means there is higher margin of safety.